Hello, good people, and welcome to Unit 6 on the stock market. In our previous unit, we talked about banking and investments, and we touched on the stock market briefly, but in this particular unit, we're going to get a little more into specifically stocks and that sort of investment and how they roll. Let's get into it. All right, so let's talk about what in the world is it first and foremost. This is how public portions of businesses are bought and sold globally, okay? So the public parts of a business we call shares. All right, so if someone buys like a share of Amazon or a share of Walmart or a share of, I don't know, Vans. All right, if you buy like a piece of a business, that's called a share. Sometimes they're called securities. Shares and securities are slightly different, but we really don't have to get into that. All right, so the value of whatever share it is, or the value of this piece of this business, is determined by how much demand a consumer places on it, okay? So how valuable it is depends on how people view it. It's all just like perceived value, okay? So, for example, I know I keep talking about Amazon, but sorry, that's a good example. In January of 2020, Amazon stock was worth about $1,800 a share or $1,800 a piece. So in order to purchase that piece of Amazon, you have to pay $1,800 up front. Right now, it's worth, I want to say, 35 in October of 2020. So it has almost doubled in 10 months. So its value has increased because of demand from consumers, demand for the business and demand for the stock itself. All right, so if more people want this business, the demand for the actual stock itself goes up. This allows companies to receive money in order to expand and grow the business, maybe build another office or like work on their shipping stuff. So people who own parts of businesses or people who own shares are known as shareholders. Okay, so let's talk about risk versus reward, because if you think back to Unit 5 when we spoke about risk in that little pyramid, stocks are pretty risky. The only thing riskier than investing in stocks are investing in collectibles, because those are like very volatile. They're very like dependent on how people demand things, and so stocks are the same way. So owners of a large set of shares and therefore have a large say in the business are known as majority shareholders. Their voice actually counts. If I own one piece of Amazon, they are not going to come to me and be like, hey, what's your opinion about the business? They don't care. I own one piece. Like Jeff Bezos owns millions of pieces. So if you think about that, people who own large portions of shares, like enough to shut the business down if they wanted to, that type of thing is a majority shareholder. It's lower risk to be a shareholder with smaller portions. You don't have as much risk because you could lose less money, but it also brings you less reward. So large amounts of stock could lead to large amounts of profit. It could, but it's not guaranteed to make you money. If you want a guaranteed way to make money, stocks ain't it. But if you want a way to make an absurd amount of profit, stocks are for you. Okay? If you want to make a lot of money in the stock market, you're going to have to risk a lot of money in the stock market. But again, it's like playing cards. It's not guaranteed. I cannot guarantee that you're going to win that bet that you take. Essentially, stock market is betting on how good businesses are going to be. It's very fancy gambling. So who's involved? Any and all business owners who want to make their business at least a little bit public so people can buy into it. That's called a corporation. And anybody who has a corporation is therefore eligible to be in the stock market. When you put a corporation together, you have to go to the United States Securities and Exchanges Commission, or the SEC, and you have to get an incorporated like set of paperwork. If you want to put like comma Inc., period, like Monsters Inc. or whatever. If you want to put Inc. behind your name, that means it's incorporated, which means that you are then allowed to buy shares into the business. If you want to do that, you have to like file paperwork with the SEC in order for them to confirm that you are a real business and you're not trying to swindle people. Okay, so we just said this. A corporation is a partially public business licensed to have investors. Added syllables. So over time, enough businesses wanted to buy and sell pieces or trade pieces of their business in order to grow and expand that people would get all of the pieces of these businesses organized into markets, and they popped up in typically major cities like New York, Chicago, Los Angeles, Tokyo, London. Beijing has one. Shanghai's got another. New Delhi in India has one as well. So these are known as stock exchanges. All right, so let's real quick talk about a trader versus an investor. A trader is a person who buys, sells, and trades short-term for profit. So the people, it's not just businesses who are involved. Like businesses can share part of their business. However, they also have to have people who buy them. And so on this side of the exchange, we have a trader and an investor. So a trader is a person who buys, sells, and trades them really short term for profit. People call these day traders. It can be very risky. You can gain pretty quickly, but that means that you're going to have to buy a high amount of shares. An investor is a person who buys, sells, and trades for a long-term gain. So you buy a stock and you let it sit. You don't touch it. You don't trade it. You don't mess with it. You just let it grow. Typically, an investor, instead of buying a whole bunch of one type of stock, is going to diversify their portfolio. Remember talking about that? They're going to buy a whole bunch of different shares. They're not going to just buy one specific thing. So they split up the risk among the shares. So if Amazon tanks and you only had 10 shares of Amazon, you didn't lose everything. You just lost a little bit of your money. All right, so where did this even come from? It started like way back. We're talking in the old world. Like just like insurance, it started way back in a long time ago in like the 1500s when financing ventures into the new world and exploring into the new world for like, I'm going to go set up a gold mine. Okay, who's going to pay for it? So if you wanted to do something like that in the new world, you had to go find somebody to pay for what you were doing if you couldn't do it yourself. So they would do like paper shares. They would take a business and be like, you have this part of my profit, and they would sign it, and you could either you can buy them, you can sell them, or you can trade these paper shares. This happened a lot during the Industrial Revolution in order to get people to start up some money to like make inventions or build a factory, that sort of thing. The first like seriously organized exchange got started in London because this was the center of the Industrial Revolution in a coffee shop. And then the first like full-out exchange in the United States was in Philadelphia because that was our capital city for a long time in colonial times. And then the one that is largest in the United States is the New York Stock Exchange, or the NYSE, and that got started in 1792, a couple years after our Constitution was written. So how do we know how the market is doing? Speaking of the market, we know who's buying, we know who's selling. How do we know if it's doing okay, though? Because it's crashed in the past, it's taken like some big dips in the past. How do we know how it's doing? Well, we can check on these things called indexes. So if you are a doctor and you're checking on the health of the stock market, you need to look at this person's symptoms, all right? So you need to look at some indicators that show you how this person is doing. Like, for example, if you go to the doctor, you got a fever, they're going to think that something is wrong. If you go to the doctor, you've got a rash, something is wrong. So they'll look at your skin, they'll check your body temp, they'll check your appetite, that sort of thing. Indexes are kind of like the appetite, the skin, and the fever, or whether or not you're doing okay for the stock market, okay? So they're just groups of businesses that give like a general vibe for the market and like how's it doing overall. This does not tell you how each individual business is doing, but it does tell you how the whole market as a group is doing. These businesses are pretty consistent. The major indexes are called the Dow Jones Industrial Average, the Standard & Poor's 500 or S&P 500, and the NASDAQ, which is like the National Association of Stock something or other quotation nonsense. You don't even know what that is in your life. Anywho, let's get into it. So the Dow Jones Industrial Average it measures the overall health of 30 big corporations like Coca-Cola, Walmart, Google, that sort of thing, just like 30, like a big set of 30 corporations. The NASDAQ measures the overall value of informational technology companies that are pretty much nonprofits, like things that are not Google and things that are not Microsoft, that sort of thing, like any small informational technology companies. So Dow Jones is worried about the big 30. NASDAQ is worried about technology. And the last one is the S&P 500, or the Standard & Poor's 500. So they measure the value of the top 500 companies in the entire world, okay? And so in order to be one of these 500, you get chosen by a committee, and you have to meet a certain set of criteria. So it's like the college top 25, how like they decide who wins and loses based on or they decide who like goes up and down in the polls based on who wins and who loses and how strong of an opponent did you beat and that sort of thing. It is the top 25 for college football except in business. Okay, so how does it impact the global economy? Well, stock prices are affected by trends, politically, economically speaking. The pandemic has hit the stock market pretty hard because some businesses are not doing so well, and so people are not confident in them, and therefore their value decreases. So big highs and big lows in the stock market are called a bull market. We've just come out of a bull market, and we've been out of it, oh man, I'd say since probably March. Small highs and lows are known as a bear market. So right now, I'd say we're kind of oscillating between a bear and a bull market right now. It's still in the middle of the pandemic. Companies can offer, if you want, you can offer an IPO or an initial public offering to raise money and expand, which is how you buy a piece of stock. Consumer confidence also impacts the global economy. So if you don't trust that company anymore, you're probably not going to invest in it, and therefore the value of that stock is going to decrease. So consumer confidence is confidence in a person and in a household. Investor confidence is how likely you are to invest in a company. So consumer confidence is the business looking at you as a consumer and be like, yo, how are we doing on savings and spending? And investor confidence is you looking at a business and be like, listen, you're acting a fool, I'm not investing in you. Okay, so consumer confidence is a measure of a household spending and saving, and then investor confidence can impact stock value both increasing and decreasing. Bears and bulls. There we go. All right, and we will get into that in our next lesson.